Markets and yields are hovering at levels that we saw on Monday here starting the week yesterday. Traders still expecting stocks to be under a bit of pressure from more cautious tones from Fed speakers this week after Federal Reserve Chair Jay Powell dashed some hopes of a March rate cut. We want to bring in Keith Lerner joining us here on set, Truist Co-Chief Investment Officer. Keith, let's talk about what we've heard from Powell over the last week. Nothing too surprising, just given the fact that he essentially took a March rate cut almost off the table. Reiterated that line of thinking again on Sunday. What does this mean then for the markets? Could we be headed for a correction?
Yeah, first, I just want to say it's just an honor to be with all three of you. You got Mr. Brian Sazi and
Big morning.
Big morning.
We're going to have you back either way, whatever you say.
Big morning. So I think right now, obviously, as you said, Powell pushed back against the narrative of March. We thought that was premature anyway because there's, in our view, the Fed has scar tissue from this inflation that we've seen over the last year and a half or so. So of course their reaction function is going to be a bit slower. But from our vantage point, I would take a more resilient economy with less Fed cuts than a more aggressive rate cuts because the economy is weakening. If you go back to 2008 or 2001, we saw very aggressive rate cuts. Didn't stop a recession. It didn't stop the stock market from going down as well. But I do think there's a little bit of a recalibration for the overall market with this adjustment.
The Fed is also keeping a close eye on the housing portion of this economy too, because if we think about the consumer and what's really going to get them ripping and rolling back into the housing market, it is cuts. So how many cuts do we need to see to spur housing, but at the same time for them not to get too ahead of their skis?
Well, I think the housing market's going to remain bifurcated because a lot of folks, and the reason why this economy has been so less interest rate sensitive is because a lot of folks are locked in at 3% and they have all that cash flow. So inflation is going up, but their house payments are staying the same. It hurts the new home buyer as well. And we just saw mortgage rates go back above 7%. That's a big number as well. What's notable, though, you just get a little bit of a downtick in rates and you see people come back in the market. So I think to your point, the direction is to reduce rates over time. And I think we'll probably see three or four rate cuts. But what's good, in my view, is that now the market is more aligned with what the Fed is. So I think, again, that recalibration is a good thing.
When you talk to clients, how concerned are they about the election? Do you hear a change in their tone when they ask you about this? And are they making changes to their portfolio today?
Yeah, as a strategist, my least favorite year is around the election time because people tend to make the wrong decision based on their political views. And we write a paper every 4 years just saying, don't mix portfolio and politics. To your question, it's starting. It will get, as we go further in the year, we'll start having that as one of the main conversation. But I tell clients today, markets have done good and bad under both Democrats and Republicans. More important for this economy and stock market is the Fed going to be able to stick this soft landing? I remember back in 2020, that was a heated election as well. And we wrote a note back then saying, I know you have a sensitivity around the election, but what happens with COVID? What happens with the vaccinations and so forth? It was notable in November, right after the election, Pfizer came out with their vaccine and the market took off. So again, I'm not saying it's not important and it could certainly drive different industries and so forth, but I think the direction of the economy is more important.
Keith, are they raising cash now? Like if they're sitting on Magnificent Seven paper gains, are they selling a little bit now or moving to treasuries or not?
No, we're not seeing anything really directly related to the election yet. I think, listen, we haven't really seen all the rhetoric that's coming. We know as we get deeper in the year, that's going to drive more of those conversations. We have seen over the last year, obviously, a lot of money in money markets and treasuries. And I always tell people that everyone loves 5% treasuries until the market's up 20% itself.
Okay, well, one thing that we have seen is there's still a lot of excitement surrounding AI. When you take a look at Palantir, the results that we got last night, that's up about 20% here shortly after the open. There's been so much talk of an AI bubble and whether or not that is maybe at risk of popping anytime soon. Is there still an investment opportunity in AI? And I guess, how are you advising clients to identify those more attractive opportunities?
Yeah, it's a great question. And I think one we're all wrestling with, as you talked earlier about that Magnificent Seven. So I don't think there's an AI bubble yet. There's definitely parts of the market that's speculative. But I think if you think about AI, we're still in the early phases. We've had the infrastructure, the chips and so forth. The next phase of this is going to be the adopters and what businesses are able to amplify this. If you think about, and I got into business in 97. I equated back then, you had like the Cisco systems of the world building the infrastructure, and then you had the Amazons leveraging. So I think what we're going to see over the next few years is really the transition on who's really leveraging AI the best.
And I mean, it just goes to show that further when you have a company like BP who reports earnings and even slides an AI reference in there. So I'm just sitting here like, okay, so we're talking about an oil and gas energy company that's now also saying, hey, we've got that AI out there too that you've been talking all about. I mean, at the end of the day, for any investor that's kind of looking out to a 2-3 year time horizon, trying to position their portfolio, is AI where they should be perhaps pushing the most chips into right now, or is there another kind of trade at play?
Yeah, I still like AI. We still like tech. We're overweight tech. We're still there. But I also say, sometimes you start seeing the market just very narrow, and everyone wants to just go to this one area. We're overweight, but going back to the 90s analogy, there's also something called the Four Horsemen. Brian, do you remember those Four Horsemen?
Vaguely, not the names,
okay.
but yes, I vaguely
Well, there's all these
remember
acronyms
that, yes.
that comes back again, but I think it was Microsoft, which is the one stock that's at a new all-time high, which is flat for 15 years. There was Dell that went private. Intel, which is down, which is 20% below where it was beforehand. And there's one other one, which I was hoping Mr. Sazi could help me out with.
Drawing a blank. It's been a long morning.
I put you on the spot. But my point is, there's a lot of progress. I think we have more, to your point, early innings from an economic standpoint, productivity standpoint. But there's not everyone's going to be winners either. So I think you're going to start seeing more. And by the way, I'm even hearing now people aren't calling Magnificent 7. They're saying the Magnificent 5.
Yeah.
So the acronym may change.
Are you just alarmed by how investors are just concentrated in 7 stocks? What about the other 493?
Yeah, it makes it challenging because when you look at all the sectors relative to technology, the relative price, like comparison, everything is breaking down because you have so much concentration. So we're there, but it makes it hard because the other areas of the markets are relatively cheap. And we're talking about the economy's been relatively resilient. And really what you want to see, which you haven't seen so far, is this pouring out. So industrials is at an all-time high along with tech. That's the only other sector. We did recently upgrade financials based on the premise that we think the economy is more resilient. That should help big cap financials as well. But really, that's the thing that I think we're all looking for. We haven't seen that yet. And the earning trends, if you look at the revision trends, the strongest in growth, tech, communications, discretionary, and then financials.
With these 3 laptops in front of us, we wouldn't be resourceful as we could be if we didn't look up the 4 horsemen for our viewers out there, and to close the loop on it, Microsoft, Intel, Cisco Systems, and Dell.
Yeah.
Okay, so we mentioned Cisco already.
We were 75% of the way there. Keith, we
Thank you.
appreciate the time as always. Keith Lerner, Truist Co-Chief Investment Officer, and thanks to our own Brian Sazi joining here for the morning as well.